One event dominated the markets this week. Thursday's US Federal Reserve decision saw gold jump to a new 6-month high as the Fed announced a third round of quantitative easing. There are two major differences between QE3 and the previous two rounds. Firstly, this latest version will focus exclusively on mortgage-backed securities rather than US Treasury bonds. Secondly, QE3 has no fixed end date. Instead, the Fed will buy $40 billion of assets each month until it sees a substantial improvement in the labour market. In its official statement, the Federal Open Market Committee said that if the outlook for the labour market does not improve substantially, the committee will continue its purchases of agency mortgage-backed securities, undertake additional asset purchases, and employ its other policy tools as appropriate until such improvement is achieved in a context of price stability. Fed Chairman Ben Bernanke called it a Main Street policy and added that the Fed is trying to get jobs going and meet its maximum employment mandate. That didn't stop it being popular with Wall Street though. Stock markets rallied following the announcement, while on the currency markets the US dollar fell. This helped the euro climb to its highest level since May, while gold and silver also gained. Friday afternoon's London gold fix was $1,775.50, its highest level since February, and a 2.7% weekly gain. Friday's silver fix, meanwhile, was $34.71, a gain of 7.7% on the week. By contrast, euro gold prices ended the week lower, despite seeing an all-time record high during Friday morning's fix. One other key piece of news this week came from Germany, where the Constitutional Court ruled that the Eurozone's new permanent bailout fund does not contravene German law. This clears the way for the European Central Bank's policy of unlimited sovereign bond buying that it announced last week. Western monetary policy has entered a new phase. The first 2 weeks of this month have seen two major central banks, the ECB and the Fed, commit to open-ended asset purchase programs. Both are insisting that the moves are consistent with their respective price stability mandates, despite growing fears that they could lead to higher inflation. The Fed has even taken a leaf from the Bank of England's book, suggesting inflation could fall below its 2% target over the medium term, as a way of justifying its stimulus measures. While we wait for this medium term, however, those with savings continue to receive negative real interest rates. John Maynard Keynes famously said that in the long run we're all dead. While that is undoubtedly true, it also seems likely that in the medium term many people will be broke. To keep up with the latest in gold and silver, visit goldnews.bullionvault.com.